We'll just start with inflation. You could call this the word of the year from 2022, probably. I'm not going to sit here and say that it's a non-factor for 2025 because I do expect it to be somewhat of a factor, just given some potential changes in Washington.
Policy, tariffs, whatever it might be.
Yeah, but at the end of the day, I think the Federal Reserve has more or less done a good job of managing the general level of price appreciation in the economy. And, we've gotten to a point where consumers have been able to digest the level of inflation. And I actually think we've found somewhat of a middling bottom here on inflationary measures, whether you look at the Consumer Price Index or personal consumption expenditures, which I'm showing on the screen right now. Those both show essentially the same thing, just calculated a little bit differently. But, we're running at about, 2.5, 2.75% year over year price increases. It's above what the Federal Reserve target is or what the generally expected kind of level is. But, realistically, I think the trajectory that we've seen over the last year and a half, 2 years as being coming back down to earth, really, that's kind of all we can ask for right now. And we've found a balance at a level that, again, consumers would not be spending at the level that they are if it wasn't palatable.
So this is controversial, the question, and answer, it doesn't matter how you answer, but I'm curious both of your thoughts. Powell, at many points over the last couple of years, has talked about inflation being transitory, meaning it's going to come, it's going to go. When you look back at the chart on inflation, was it transitory?
I think it's really hard to say that. When you look at that chart, it's kind of like, in hindsight, how could you miss that, right? Like, you just came out of this period where you pumped a ton of dough into the economy. People were staying home and spending money like crazy on random stuff. Supply chains were throttled. How did you not see this coming, right? That's in perfect hindsight, but in reality, we have never really been through anything like that before, right? Like, I think that's where I want to give him the benefit of the doubt, because that was a pretty ridiculous experience that we went through. And, if I'm being completely honest, like, living through the last 15 years of trying just to get to 2% inflation, yeah, I would have no reason to believe that we would consistently be above 3, let alone above 8 for a period of time.
Well,
right?
What do you think, Matt?
Yeah, so parts of it were transitory, right? Used auto prices. There was a time when used auto prices were a massive driver of inflation. No pun intended. Lumber. People remember lumber spiking in early COVID. There were a bunch of individual segments that contribute to CPI that were absolutely transitory.
Yeah.
Now, the big one that isn't and has not been has been housing. So housing's been the tough nut to crack for the Fed, because high rates have people locked into their house at lower rates. We have an inventory problem. Prices are not coming down. And, Daniel, as you've highlighted, that's the biggest contributor to inflation. It's been shelter. So I would say, yeah, 50% of the CPI calc, absolutely transitory, but this massive other 50% or a third is not. And there's no easy way or no easy solution other than building inventory, which, for obvious reasons, home builders are more reluctant to do.
So I'll generalize here in saying that inflation is somewhat under control. It hasn't flared up. The spike has been tampered, and we're not in an environment, at least at this point, TBD where 2025 goes, but inflation is relatively under control. Maybe not at Fed targets, but it's close.
Yeah. Well, and like I said, kind of at the onset, if what leads me to say that it is in a reasonably good spot is that, look, if prices were overly cumbersome for the average consumer, then you would not see consumer spending contributing to GDP. Yeah. And instead, what I'm showing on the chart right now is quite literally just the consumer spending piece of U.S. gross domestic product, which is basically just U.S. economic growth. And consumer spending on average constitutes 2/3 to 3/4 of that. So for the last 3 years to be running on average, plus 2% and more, Even this year, I mean, we're kind of running at like 3% per quarter on a seasonally adjusted annual rate. I mean, that's just not an environment where prices are prohibitive, right? And that should be taken as a positive sign for not just the consumer, but more so for just the business operating environment.
You see it in price. Consumer discretionary stocks relative to more defensive areas like consumer staples, consumer discretionary on a relative basis has been blowing up, all-time highs.
And I would say that the one thing, I think the expectation or economics 101 will kind of lead you to believe that I just don't see prices coming down, right, anytime soon. I mean, the economy's strong enough that it's going to support the current level of price. Doesn't mean we continually get these increases, which I define, sustained inflation as a year over year phenomenon. And what you could see from the chart that you had posted earlier was that we had that blip from the demand side during COVID, and we just don't have that anymore. It's really worked itself off.
And so the consumer spends why? The consumer spends because they're employed.
Yeah.
So labor has been relatively strong. I know labor has weakened to a certain degree, but overall unemployment rates are still, I don't know, could you say historic lows?
Still.
But they're close.
Yeah.
They might not be at all-time lows, but they're pretty darn low.
Yeah, and I think that, coming into this year, we talked a lot about that side of the equation because, it was for a long period of time, the whole inflation situation that was the focal point of many economic conversations, the focal point of the Federal Reserve. But to me, coming into this year, it was like, okay, let's take a pulse on the labor market. We started to see some cracks, and we definitely have seen a bit of a slowdown this year. Now, again, I will caveat that by saying a slowdown off of really strong month-over-month job additions is not inherently a bad thing. It's getting back into balance. I do think you're going to see a somewhat of a continuation of this kind of coming back down to earth. So if you look at the chart that I have on the screen, it's showing non-farm payrolls month over month. That's just new jobs added in the economy each month. And over the last few months, we're kind of finding an average of, call it 150,000 a month or so. And you can see the chart, there's a clear downtrend, but that's not unexpected as people kind of return to the office, return to work. There was a lot of weird things happening within the labor market that were skewing these pieces of data. But now as you kind of develop this longer term trend and you are able to zoom out and look at this 3-year period, I think what you're finding is that the labor market has started to find, again, like inflation, find somewhat of a bottom. And it seems to be one that's fairly comfortable, absent some blips that we got, over the last month or two with some really odd stuff that was happening. So long story short, I think we're in a pretty good spot. I'm not going to sit here and call it like a Goldilocks environment, but I do think that we've started to see a lot of shakeout happen. And where the dust is settling is one of relatively low unemployment, relatively, I would say, consistent consumer spending and manageable inflation. I mean, that to me is a pretty good operating environment for corporations.
We have sell-side analysts on one side, extreme bullishness. I'm feeling a lot of sentiment from our clients and prospective clients in terms of bearishness, only because the market's up, it has to come back down. What goes up must come down. The way it plays out is likely somewhere in the middle. We don't really know. We don't have a crystal ball. What do we know? We have to help our clients build, execute, navigate financial plans. Is it important to identify a 12-month price target and get it right? Probably not. It's probably more effective to build a financial plan, operate that financial plan, be tax efficient, understand how your estate is set up, all the things that we do with clients, right? That make a big impact and navigate the markets along the way. And we take what we get from the markets and we make the best decisions. But really at the end of the day, focus on the financial plan. Let the plan drive the portfolio. Let the data that comes in from the economy or from the markets, let that drive decisions in the moment.
Yeah, I mean, because we have a sell-side year-end target on the S&P doesn't mean we're going to get there in a linear fashion. It's going to be a smooth ride.
Yeah,
right.
Never.
It never is. So those are really, to me,
and I've seen
worthless.
I've seen so many of those predictions in the past, and I can't remember what year it was, but it was classic. We had the top 20 strategists on Wall Street that ranked in order the performance expectations for each sector, and not a single analyst in this particular year that I'm referencing had utilities at the top. In fact, they all had utilities at the bottom, and utilities were the number one performer that year. Yeah. So it's that kind of thing that happens. So I don't know, just thoughts on what my final comments were.
No, I think that's great. And like I said, we deal with expectations. We expect the companies to raise dividends. We expect diversification to help. We expect there to be 5 or 10% corrections. We build portfolios, diversified portfolios, in the event of there being some type of normal pullback. Geopolitical risk. We're always trying to, we create a portfolio with those thoughts in mind.
At the end of the day, what I was trying to say is it's not about throwing out a prediction and that prediction being right or wrong. There's so much more under the hood.
Right, exactly. And what I would expect is that market timing is not going to be the best strategy of the year. Yeah. So why try?
I think we covered it all.
Cool.
Yeah. Well, I thought that was a productive discussion. Hopefully the audience enjoyed it as well. I don't know. I like stepping back and talking about realistic expectations instead of, we could sit here and guess at which sector is going to provide the best return next year. But quite frankly, I just don't think that's going to be in anyone's best interest. So,
any Super Bowl predictions before where the Lions going to fall this year?
I can't even.
Injuries.
Can't say it.
So I expect them to make the playoffs. Yeah. But that's back 10 years ago you would have predicted them to make the playoffs, and now I think the expectation is playoffs. So it's a good spot to be.
Yeah.
Yeah.
Positive momentum.
Expecting a fun season.